Hello, everybody, and welcome to RealWealth Webinars, RealWealth Network's weekly webinar. My name is Ben Eric Smith. I'm here with Caeli Ridge. Hi, Caeli.
Hi, guys.
Of Ridge Lending, and we're going to talk about, as you can see on your screen there, conservatorship, investor loans, and rates with Ridge Lending Group. So today's August 12th. Happy to have you with us. Got a few little housekeeping things, and then we'll get right to it. So if you don't mind, Caeli, just go ahead and advance for me. All right, strategies mentioned in the presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and/or attorney to discuss your specific situation. Past performance is no guarantee of future results. Obviously, we're talking about loans and possible loan rates and what may or may not happen, so that's not completely applicable, but you never know what will happen. Real estate purchases are subject to investment risks, including the possible losses of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. So that's a little bit more applicable to a property provider, but you know, there's a lot of uncertainty in the loan environment too. So it kind of applies. So advance, please.
Yeah.
All righty. So Caeli, I'm just going to go ahead and introduce you because it's always awkward to introduce yourself, but 23 years as a nationwide lender and loan officer in both residential and commercial type properties. I mean, when I started in 2013, I think it was, with RealWealth, there you were. So you've been with us the entire time. What I think sets you apart is that you're an established real estate investor yourself. And like it says up there, 42 established properties at any one time. So many lenders I talk to, even if they might specialize in non-owner occ investor loans, you ask them, hey, do you invest in anything? Well, no. So they kind of lose a little bit of credibility at that point. So that's not the case with Caeli Ridge. So that's nice. Help thousands of investors realize their dreams of financial independence through real estate investing. And Ridge Lending is the preferred lender for over 9 dozen. Wow. Investment networks. Yeah, that's a lot. Yeah. Investment networks nationwide, making her a true leader in real estate investing. Very nice, and your hair has grown out since the picture.
I washed it. I'm ready for this. Yes, this is all for your RealWealth listeners. Thank you very much, Ben, for that gracious introduction. You know, in looking at this, some of it's a little bit canned, I know, but I want to add some things to the people out there that are with us today. I think that as a company, we're very well suited to accommodate all types and sizes of investors, but a few things that aren't mentioned there that I think are some significant value adds. One, that we are a nationwide lender. We're in almost 50 states. There's 5 states that we're not in. I'll just list those for you guys really quick. Alaska, Maine, North Dakota, New York, and Vermont. Otherwise, we're everywhere. So we have a nice broad footprint. And the other thing that I want to touch on or highlight is we really focus a lot of our attention on education, which is very similar to what the RealWealth Network does, and why I think we're such a well-aligned network and lender together. Information is power. I know it sounds trite, but it really is, and what you don't know can hurt you. And I think in particular, when we start talking about the financing side of things, everybody agrees that the learning curve in real estate investing, just on its own merit, is extremely intensive. I'm always quoted as saying, when we start to layer in all of the financing elements, that it exponentially increases those learning curves. And for, I would say, the vast majority of people that I speak to daily, it's the lending part of this that they feel most overwhelmed by. You know, drinking through a fire hose is the visual aid that I like to give, but it's a lot. And because the leverage and the use of other people's money is going to give you your greatest rate of return on investment, it just seems obvious to me that you're going to want to have some baseline information, understand what are some of the guidelines as they apply to you as you exist today, and later as you evolve and as your qualifications change. Knowing how to optimize those things from an underwriter's perspective is just, I think, very, very important. So if I were going to highlight one thing, a super big value add, I would say that education from Ridge is really what we're about. So, okay, that's enough of that. Let's do this.
Yes, absolutely. Go ahead and advance, and let's see where this takes us.
Okay. So Ben, I'm gonna take it from here. Is there
Yeah,
anything else?
I mean, I'm not just going to sit here like a wallflower. I'm going to ask questions and think of things, but I mean, you're the expert in this area, so I don't think people want to hear from me too much. But if I think of something, I will throw it in. And since I didn't mention it, if anybody does have any questions and you're watching this live, then type it into the GoToWebinar control panel. If it's apropos to interrupt and ask at the time, I will, but most of the questions I'll kind of save towards the end, the last 15 minutes. But we've got a framework here of a bunch of things we're going to go over, and a few things I've got on my little notepad here that I'm going to ask afterwards. But I've already got a question coming in, but yeah, you take it away and I'll jump in.
Cool, I love it. And I'm going to try and get through quite a bit of this as quickly as possible. I feel like on the finance side, the Q&A is the most valuable, people. So let's get through what we can and then open it up to questions by all means.
Yep.
We'll try to accommodate. So a couple bullet points here just to kind of give you an idea of what we're going to be talking about today. For those of you that are not aware, currently conservatorship, Fannie Mae, Freddie Mac is one of the product lines that we offer for real estate investors. We're going to talk a little bit about conservatorship. If you watch the news and are plugged into this kind of thing, you've heard that there might be some changes to that. I'll tell you what conservatorship is, when we might expect to see some changes, and what results will come of that. We're going to talk real quickly about what loan options Ridge Lending has. I'll get into some of the qualifications. I think I'm going to go kind of quick on that part. It's really subjective to the individual's needs and more of a one-on-one, I think, but I'll highlight some of those things. And then finally, rates, right? Rates are a hot topic for anybody that I talk to. It's one of the first things that most people want to know about. So we will spend some time talking about where we've been, where we are, and where I think we're going to go for rates. Okay, so let's do this. And I did have a request before I got on. I don't know if he's on the call here, but Mr. Parham, if you're watching, I'll make sure to accommodate at some point during the broadcast, okay? So I think that this is out of order, gang. I didn't look at the final product when it was provided to me. I thought that there was something else. So I'm just going to go back to this slide, and I'm just going to talk about conservatorship, and then we'll get into some of the loan products, okay? So 0809, a lot of people on the call, I'm going to assume, remember the debacle, the implosion of the housing and lending markets as a result of the 0809 crash. Well, from that, most people will be familiar with the name Dodd-Frank. Those were two individuals from the House and the Senate that created a very robust update to guidelines, regulation, compliance to all things finance. Certainly impacted the mortgage industry. One of the things that happened as a result of all of that was that they put Fannie Mae and Freddie Mac in conservatorship. The United States government now is basically insuring Fannie Freddie. And one of the reasons that we are able to see and have kind of exploited is not the right way, but enjoyed very low interest rates over the last up and downs, sure, but over the last 10 plus years is because a mortgage-backed security is currently insured, Fannie Freddie, by the United States government against default. So if there's an investor on Wall Street or secondary investor that's purchasing mortgage-backed securities that were funded by Fannie Freddie, that comes with a U.S. guarantee. That's a big deal, and that's why the rates are so low. So that's what conservatorship is. There has been some talk, long talk. Ultimately, it was supposed to be a short-term thing to put Fannie and Freddie in conservatorship. And there's been a little bit more noise lately to remove them from that conservatorship and privatize, put Fannie Freddie back in the private sector. I could play devil's advocate on both ways. I'm not going to get into that. What I am going to tell you is that it's imminent. Removal, I believe, from conservatorship is probably year, 2 years maybe. There was a big push last year by the ex-director of the FHFA, his name is Mark Calabria, to try and remove that conservatorship during the pandemic. I disagreed with that prior to the election because they didn't know what was going to happen. It was not successful, so we are still in conservatorship. 12, 24-ish months maybe, we can expect to see some changes and it taking out of conservatorship. What does that mean? Worst case scenario, what that means is that the playing field for access to mortgages is really going to open up, right? All the suits on Wall Street are now going to be back in the game to supply access to mortgages. So what we have right now for us, most of us, we kind of live in this Fannie Mae Freddie Mac box for non-owner occupied mortgages. There's non-QM, we're going to talk about that in a minute, but making Fannie Freddie private is really going to allow for a lot more opportunity. Interest rates are going to kind of level out between what Fannie Freddie offers and what secondary and private banks might be offering. Adjustable rate mortgages will also come back into play. I believe Fannie Freddie has kind of cornered that market because interest rates are so low with that United States guarantee. The secondary market and the suits on Wall Street have not really been able to compete. So removal of conservatorship is going to, like I said, open up the playing field. There's going to be more access to guidelines. Will probably loosen up a little bit. I think that most have learned their lesson, and there's still going to be provisions within Dodd-Frank that keeps any reckless behavior at bay. So I'm not super worried about that. But rates will go up is one thing that I want to mention about this. 30-year fixed mortgage rates, if removal of conservatorship also removes the U.S. guarantee, you can bet that interest rates on a 30-year fixed basis will increase. That's why I was just saying that adjustable rate mortgages will become more commonplace again. There's something called an inverted yield right now in our space that means that an adjustable rate mortgage is actually pricing higher than a 30-year fixed mortgage, giving it zero incentive to even want to consider an adjustable rate, right? Why would you take a higher rate on a 5-year ARM than you can get with a 30-year fix? You wouldn't. So I believe that with the removal of the conservatorship and the opening, like I said, that the ARMs will be back in a position to price a half a point or a full point lower than, say, a 30-year fix. Now, let me take a minute and talk about this for a second, because a lot of people hear this and they start to panic. Oh my God, no more 30-year fixed, or 30-year fixed rates are going to go up, and maybe we're going to have to look at adjustable rate mortgages. Statistically speaking, guys, the 30-year fixed mortgage comes with a certain amount of psychology attached to it, that people just really want to focus and gravitate toward that 30-year fix. And I'm guilty of this myself, but in reality, Ben's raising his hand, the truth of the matter is that the life cycle of a 30-year fixed, someone that starts a loan today on a 30-year fixed and finishes making 360 mortgage payments later with that mortgage, is less than 1%. Okay, it just doesn't happen. The shelf life for most 30-year fixed mortgages, and this is a statistic for owner-occupied only. We know that for investment properties, this is going to be even lower. But statistically, 5 to 7 years is the shelf life of a 30-year fixed, whereby some sort of refinance or potentially sale of the property has occurred. So I'm actually a fan of an ARM when the rates are lower the way that they're intended to be, and why the only reason for an ARM would be appropriate. Anyway, so don't freak out about the prospect of the removal of conservatorship and what that might mean to a 30-year fixed. And as interest rates change up or down, remember, as investors, we're a lot less susceptible to some of that because we should be appreciating our rents anyway. So as rates go up, rents follow. They don't go at the same time, but you'll notice anybody that's been doing this long enough, they get there. So there's that part on conservatorship. Ben, any comments, questions that you think I might want to touch on with all of that?
Well, I mean, I was gonna agree, because I mean, like throughout my investing period of time, every single time I gravitate towards a 30-year because I think I'm gonna keep that loan and keep that house. And yeah, sometimes it's happened, but a lot of times I'm ending up refining anyway or selling the property. I'm like, damn it, all these years I could have been paying 2% less if I'd gotten that ARM back before the inverted yield curve like you just described. So it's just, I like to have the 30-year fix because I don't know what else is going to happen. At least that eliminates that as being a variable. And so I fall into that psychological trap too.
Yeah, it's common. I think a lot of us do that.
Yeah.
Anyway, okay, so there's conservatorship. If anybody has questions about that, I'm sure feel free to type it into the chat, and Ben will bring it up when we get there.
I do have one question. If you were to hazard a guess, okay, it gets pulled out of conservatorship, the private money comes in, rates will go up, but they're not going to suddenly jump from 4 to 7. They'll just maybe edge up a little bit, right?
And we'll get into, we'll do a deep dive into interest rates. Rates aren't going anywhere. we're going to have a low rate environment for a while as far as I'm concerned. And I'll give you what my opinion is and my 1.3 cents worth. I'll look inside that crystal ball and we'll see what we find. But yeah.
Okay.
Okay. So let's talk about loan options, RLG loan options real quick. Here we go. So one of the other great things I think about bridge lending is that we are not a one-size-fits-all. We have a pretty diverse menu, if you will, of loan programs specifically tailored for non-owner occupied or investors. And I didn't mention this earlier, we're fully functional, right? So if you need VA, FHA, owner occupied second home, we can do all of that, but we do have some special skill sets with the investor. So you'll notice here on this slide, there's 5 houses. Actually, it's 4 different prongs of loan products. That unsecured line of credit, I'm going to talk about kind of on the side. So Fannie Mae, Freddie Mac, okay? Those are the golden tickets. This is the highest leverage at the lowest interest rate on the planet that you will be able to find. There are 10 of these per qualified individual. So if you are husband and wife and you want to maximize, ideally what the advice would be if we can get you to qualify, even if it's a longer term gain and we have to start planning for it, Mr. and Mrs. Smith are each going to want to qualify for their own 10. So instead of 10 together, now they've got 20 separate. Beyond Fannie Freddie, we've got non-QM. QM stands for Qualified Mortgage. Qualified Mortgage is defined as Fannie Freddie loans, per Dodd-Frank actually. Everything outside of that box then is now non-QM, right? Non-QM in and of itself is an extremely diverse product line, and it's not just for investors. It's for anybody really that doesn't fit into a government or a conventional loan product. Things like, and I think the different slides will kind of break this down a little bit, and I could talk a little bit more about it, but let's say that you can't show your tax returns for an investment property. There's a debt service ratio product on a residential property for 30-year fixed that is only going to consider the gross rents of the property and divide it by the monthly payment, the PITI, principal, interest, tax, and insurance. That's one example of non-QM. There's lots and lots more. We'll come back to that. Commercial products. So we have a commercial division that obviously for commercial property, whether it be 5 units and above apartment complexes or it's a strip mall or whatever, that certainly applies. But there's also commercial products for residential properties that's called cross-collateralization. So you could take 5 single families and 4 duplexes and roll them into one blanket commercial loan. That is applicable. There is recourse and non-recourse in commercial funding. Recourse means you've signed a personal guarantee. Non-recourse means that you have not signed a personal guarantee. The reason that I make a point to demonstrate that is that one of the strategies that we help our clients through is, let's say that Mr. Smith already has 10 golden tickets, but he really wants to take advantage of the Fannie Freddie low rates right now, and his portfolio of 10 has stabilized and it's doing well. We could take those 10 mortgages and put them into a non-recourse, can't have a personal guarantee, a non-recourse commercial loan whereby opening up the 10 loans all over again. He's got access to them again. So that might be a strategy that we would use commercial for. And then finally, we have the short-term bridge money. So for a shorter-term fix and flip, or maybe, whatever the circumstances are, you need a 6-month or 12-month interest-only loan before, you can get your credit up, or whatever else it might be, we can stick you into that for a short term and then refinance you back into a fixed rate mortgage, for example. Or maybe really just truly flipping the deal. That would be a way that we could get you funded there. Unsecured lines of credit and delayed. I'm going to forego that one. That's pretty wordy. I think we should move on. Is that cool with you? Okay.
It is.
All right. So I'm going to zip through this. So we're going to talk Freddie. I'm going to give you guys some quick bullet point baseline qualifications. I'm going to talk fast. Anybody that wants more information, you'll have my contact information. So of all the variables that go into quantifying or who qualifies for a Fannie Freddie or conventional loan, there are tons of them. But the top three things that are most heavily weighted, we've got credit, assets, and DTI, debt to income ratio. Now, remember I talked about 10 golden tickets, right? A lot of people already know that, but what a lot of people don't know is that of the 10, there are 2 distinct books that are used to underwrite a mortgage. The first book applies to 1 through 6 of the 10, and then there's a new book of guidelines that's going to go into the 7th, 8th, 9th, 10th spot for the conventional 10. As that applies to credit, it varies. So credit in 1 through 6, really no hard and fast. 650 credit scores can get approved if they have compensating factors. High assets, large or substantial assets, or low debt to income ratio would be a qualifying factor, compensating factor, excuse me.
Right.
Assets, no, I'm sorry, I'm still in credit. 7 through 10, what happens is that when we move into those loan spots, they raise the qualification bar. We now must maintain a minimum middle credit score of 720 or greater to qualify for any of those. So be mindful of credit, and there's some tricks in there that we can give you as well about how to optimize and keep the score above the 720. There's rapid acquisition, where if you're purchasing lots of property in a small window of time, you could potentially temporarily slip below that 720 mark. So there's some tricks that we can teach you, optimization stuff that we'll share with you at a one-on-one date to show you how you can maintain that. Let's move on to assets. So assets, you've got your down payment and reserves. I'm going to keep this on a purchase basis. The down payment has to be liquid, and those funds have to be sourced and seasoned. Okay, sourced and seasoned means that they originated with you, and you can show that for the last 60 days or 2 months worth of bank statements that those funds were yours. An example of what wouldn't work would be if your bank statements that you've supplied us to show your cash to close have a large deposit. Now, a large deposit will be defined as anything over 50% of your income. So if you make $10,000 a month and I see $5,000 in a bank statement that you've sent me, I'm going to question it. If I can't show that it started with you somewhere, you can't use it. So if you liquidated some stock or you sold a car or whatever, fine. As long as I can paper trail that, you get to use it. If Great Aunt Alice said, here you go, Ben, here's $50,000, go invest in real estate, I cannot let you use that money until it's sat there for the full 2 months to where I no longer see the deposit, but only the balance.
What about if Great Aunt Alice sent that money to me? If I made $10,000 a month and I told Alice to send it to me in chunks of 4,000, it's only 40%, and she did it every 2 weeks. Would that a workaround?
Would not be questioned. The only time the deposit will be questioned is when it exceeds 50% of your income. So that would be a good workaround.
Okay.
Yep. Okay, so down payment, source and seasoned, liquid funds, reserves. Now this is a little bit more complicated, and I have a cheat sheet and a worksheet. I probably should have put this up, but what I'll do, if you agree, Ben, is I'll send the PDF to you, and maybe you guys can get it on the site for people to see.
Sure.
So the reserve requirement is similar to the credit. It changes depending on how many finance properties you have. I'm going to say this fast, and it's going to confuse everybody. So you're going to want that visual aid to go back and get that. Okay. Reserves, first of all, can be liquid or non-liquid. Your non-liquid accounts are going to be your retirement accounts, your 401k, your self-directed IRAs, etc. The amount of reserves required are going to be as follows. Our subject property, the property that you're purchasing, first and foremost requires 6 months of PITI. Right? Principal, interest, tax, and insurance. I need to show 6 months of reserves for our subject property. Each subsequent rental property is going to be a function of the outstanding principal balance times a certain percentage. So depending on how many finance properties you have, that percentage equation is going to be 2, 4, or 6%. The 2% applies to the loans that are going to fall in 1 through 4. The 4% is going to be for loans that fall in 5 and 6. And then finally 6% on 7 through 10. Now your primary residence will count in the number of finance properties, but the outstanding principal balance on your primary is not included in the equation. So I'm going to give you a worst case scenario example. Let's say that you have your primary residence in property spot number 1, and you're purchasing number 10. Properties 2 through 9 are all rentals. Properties 2 through 9 have outstanding principal balance of $800,000. Or excuse me, 100,000 each, so 800,000 total. Okay, 6% and 800,000 is what, 48,000? Did I do that right? I can't do mental math. Okay, I'm in finance, by the way. Okay, and then number 10 property, thank you. Number 10 property is a monthly PITI of $1,000 a month. That's $6,000, right? 6 months PITI. So I have $6,000 on my subject property, $48,000 for all the other 8, which was 800,000 times 6%. 54,000 would be the reserve requirement in that example. Okay, don't have to remember that. You guys will get the worksheet, and it bullet points it and gives you some examples in there. It's much easier when you have the visual aid. That's assets. Let's move on to DTI. Debt to income ratio, 50% is the threshold. Okay. Monthly income divided by monthly liabilities on the credit report. Living expenses, food, utilities, cell phone, entertainment, gas, do not count. Monthly expenses on the credit report, and then things that won't be found on there that will count are your primary housing expense if you're a renter, HOA dues, and any taxes and insurance that are paid separate from your mortgage payment, right? If you've elected to pay TI or taxes and insurance outside the mortgage, that has to be included. 50% DTI. A wage earner is super easy to calculate. Self-employed is going to be a little bit more complicated, and I will finish this bullet by saying I think that the education piece I've already highlighted as a value add for us. Debt to income ratio can be tricky, and I think that in that education, the most valuable piece that we can give there is helping our clients understand how DTI is calculated for either a more complicated self-employed person and how to help them structure that. What things can we add back and what can't we, right? A lot of times we will get our borrowers draft tax returns, we insist, before they file them so that we can take a look at it, run it through the calculation of underwriting guideline, and then provide feedback and say, okay, well, in this case, you're claiming too much over here, your DTI is going to suffer there, right? There's going to be a bit of a balancing act, and we're able to provide them with that feedback, especially when we talk about the Schedule E, right? That's where your rental properties are going to go. There's a lot of moving parts in there. I won't take us down that rabbit hole. Just know that having advance conversations before you ring the bell, before you file your return with your lender is important. Okay. Max 10, we talked about that. We talked about reserves. I'm gonna move on.
Well, okay, wait. Let me knock out a couple quick questions because they're totally appropriate. Chris, hi Chris. He writes in to say, hey, what if I want to give my son the down payment, say 100,000? Is that possible or no?
Are you going to be on the loan with your son? If you're on the loan with your son, sure.
Right. But if he's not, then no.
Then it has to sit in your son's account for that 60 days. I don't want to see the 100 grand. Now, hold on a second, Chris. Is this for your son's primary residence purchase, or is he purchasing a rental?
I don't know. All I know is what I read.
Okay. Chris, if you're listening still, if it's a primary residence, then you can gift funds all day long. That's perfectly fine to your son. If you're doing this so he can buy an investment property, gift funds are not allowed, and you either have to be on the loan with him or stick it in there immediately, let it sit for 60 days, and he's good to go.
Got it. Okay. Are you still able to count 70% of rental income to qualify?
Yes. Very good question. This is important, so if it's okay with you, BES, I'm going to get into this one. So the rental income that we can use in the acquisition year, let me back up. There's two ways that we're going to calculate rental. Yeah, go. Ben, were you going to say something?
Well, I was going to say, Chris wrote, he's quick draw McGraw, primary residence and owner occupied. So therefore, yes, he can loan the 100K to his son.
You can.
You're good, Chris. You're golden.
Okay. There's two ways in underwriting, and we're kind of still focused on conventional. Two ways that we're going to calculate the rental income in a transaction. The first way is called the acquisition year. The second way is called the Schedule E. I'm not going to mess with the Schedule E. It's too complicated. That's a one-on-one thing. In the acquisition year, when you're buying the property, which means from the date that you purchase it and up until it falls on that year's tax return. So as an example, if you purchased it January of this year, and you know for sure you're going to file April 15th of next year, the following is applicable to that property, okay? We get to give the property 75% of the gross rents minus the proposed PITI. I'm going to say it again, principal, interest, tax, and insurance. So as a round number example, let's say that the gross rents in our transaction are $1,000 a month and the PITI is $500. I'm going to give you $750 of 1,000, right? 75% of 1,000. So $750 of income. And from that, I'm going to take away the $500 PITI. So that leaves you with a $250 gain. It's a positive number, right? Mm-hmm. So I want everybody to stop and think about that for a second. I have completely eliminated the mortgage debt. It's covered, it's handled, it's gone. Your income just went up by $250 a month, higher than it was before you even got into the transaction. So what's happened to your debt to income ratio? It's gone down, right? It's actually improved your debt to income ratio. Now there are some disclaimers that you need to know about. Fannie and Freddie have a rule about primary housing. If an individual has a mortgage that they pay where they live, then what I just gave you is absolutely accurate. If you're a renter and you don't have a mortgage as your primary housing expense, I can only offset. That means that in my scenario, I can give you up to the $500 PITI, but you don't get the gain, right? You don't get to have that extra $250. You just get to offset. So your debt to income ratio would just be unchanged.
Right.
Okay. If you live rent-free, you get 0 rental income credit.
Okay.
Right? If you don't have any kind of primary housing expense, none of the 75% value or benefit is something that you can use. And lastly on this topic, the property does not have to be leased at closing in order for me to give you the 75%. We can use the appraisal of an investment property, which comes with some additional forms, one of which is called a 1007. It's the rental income comps. And whatever the appraiser deems as the median for the gross rents, that's what we'll use the 75% on. So once you own it, that's only during the purchase. Once the property becomes yours, you close on that property, you must have a lease in order to use the 75% of rental income.
Right. Okay.
Deep dive. Okay. Anything else that we want to go to before I move on?
Well, if I keep taking questions, we'll never get anywhere. So I think we need to move on.
We'll get them at the, okay. So let's talk about non-QM really quickly. As I mentioned in the last slide, non-QM, one of the cool things that we can do for non-QM is for those individuals that either don't want to be bothered with providing vials of blood and DNA samples, right? They just want to get in, get out, and get the thing done. That would be our debt service coverage ratio. I'm going to give you the formula. No income documentation is required. Now, you still have to show assets and things, right? But 0 income is required. And the formula is this. We're going to take the gross rents and we're going to simply divide it by the PITI. If that gives me a 1.1% or greater, that property qualifies. Okay? 30-year fixed, 25% down, rates somewhere in the 5.2 to 5.5. 3-year prepayment penalty on all non-QM products. And the 3 years means that for the first 36 months, you cannot sell or refinance without paying a penalty. The penalty will be 80% of the outstanding balance times 6 months worth of interest. Okay? So, I mean, depending on the loan size, yeah, that can be a big number. So debt service ratio is 1. There's also asset depletion. So if you don't have an income anymore, but you have $1 million in your self-directed IRA, we can look at that and formulate how the formulation is being able to, let's say we know that we need $5,000 a month to qualify the individual based on the monthly debts that they have, okay? As long as the assets face value equals 36 months worth, then I can give them that income. Let me say that in a different way. So let's say that $5,000 a month is what I need for this individual to qualify. Okay, and the asset statement that I have, the asset statements that I have for this individual have 500,000 in it that I'm able to use. 5,000 times 36 months, I only need to show 180,000 in the asset in order to use that income to qualify that person. Now, there's some other criteria that you have to fill out and make sure that you do, but asset depletion might be another way to qualify under a conventional, actually, that actually works conventionally too. But in the asset depletion, that would be another option. Bank statements, 12, 24 months worth of bank statements. You add up all the deposits, you divide by the number, and that would be the income that we would give them. We would mirror it to a P&L, but that would be another way to also qualify. Non-QM does not care how many finance properties the individual has. So very often, once we've exhausted our Fannie Freddie over here, we just simply move into the non-QM. If you're going full doc in a non-QM, similar guidelines apply to Fannie Freddie, and the primary difference between going Fannie Freddie after you've exhausted your 10 into the non-QM full doc is probably about 3/4 of a point, 1 percentage point. So if you're at 4% on a Fannie Freddie today, you're going to be 5% on a non-QM. Similar guidelines, similar terms, etc. Okay. Anything? I'm going to move on.
I've got one actually pretty good question on how is income defined in the debt to income DTI calculation? Is it taxable income, which is reduced by depreciation expense, or is it your actual cash income?
Depending on the type of earner you are. If you're a wage earner, we're going to take your gross income.
Okay.
If you're self-employed, we can add back things like depreciation. There's certain things we get to add back.
Okay.
So it depends on
Okay.
what kind of earner you are.
All right.
You know, I wonder if you think it's worthwhile to get into the commercial stuff.
If you could kind of keep it brief, I mean, we do very little commercial
Okay.
in our audience, but it's still interesting, but just keep it brief.
So I think in that case, then why don't I just quickly touch on how you might want to use commercial lending for residential property. As I said initially, you could take any number of residential homes, single family to 4 units, right? That's what defines residential, and put them into this blanket commercial loan. Minimum loan size for this is $500,000, 75% LTV. Debt service is looked at greatly. We're still going to look at the individual's income, but it's really more about the property, right? Commercial underwrite is very different than residential. 30-year amortization on these loans, and you're probably looking at something like a 5 or 10-year balloon or 5, 7, or 10-year ARM. And depending on the circumstances, I see this as a very viable product for those that want to continue to scale maybe, or like I said earlier, want to open up conventional loan spots. Any specific questions or scenarios you guys want us to run, just let us know.
Okay.
I'm going to move past the delay. That's too wordy. So we can stay here, but I want to talk about rates. Let's close out rates, and then we can kind of open up to the Q&A.
Okay.
So, you know, interest rates are interesting. I'll give you a little bit of history where we are now, where I think we're going to be. But before we get into that, it's important, I think, as an education piece to comment that interest rates are not created equal. There are a whole variety of variables that play distinct roles in how each individual rate will be locked and what the rate's going to be. These variables are just the characteristics of the loan. The occupancy, right? There are things called, let me back up. There are things called price adjustments. These price adjustments come in the form of positive and negative numbers that associate or attach to the individual characteristics of the loan. Occupancy, right? A price adjustment on an owner-occupied loan versus a non-owner occupied loan are going to be wildly different. Loan size, loan to value, property type, credit score, purchase versus refi, cash out versus rate and term. All of these variables have their own unique price adjustment, and that's why there's such a wide variety of interest rates that are being locked. You know, a lot of times, and I get it, I'll have clients come to me and say, well, Caeli, my mom just locked at 3.25 last week, and you're getting me a rate of 4.5, right? When we are able to explain, well, that was a rate and term refinance for her primary residence, and we're talking about a 20% down purchase for an investment. So those variables are very, very important to understand, first and foremost. So let me take you back to earlier this year. We were still just swimming in a world of ridiculously low interest rates. For non-owner occupieds, we were in the 3s up until sometime middle to the end of February. Inflationary concerns started to kind of take hold. Rates started to increase. But then in March 10th to be specific, we got an interesting announcement that at least anybody in my sphere was not prepared for, didn't have any forewarning with. Fannie and Freddie announced that their senior preferred stock agreement with the U.S. Treasury has required that they start to add in layers of risk. They deemed layers of risk for occupancies, second home and non-owner occupied. This announcement basically said that they're going to limit their exposure to 7% per purchased aggregator. So what that means is that if I have, Ridge is a direct lender, so we fund on our warehouse lines. We don't service our loans, so we fund bundles of loans and then we sell them on the secondary market, and we have dozens of aggregators that we would sell to. So if I'm going to bundle $10 million worth of mortgage-backed securities and sell it to this particular aggregator, what that means is that no more than 7% of that bundle can have second home or non-owner occupied occupancy in it. Okay, so in and of itself, that's not very damaging to us because we have all kinds of outlets. That's fine. But the result of the announcement, what happened is that Wall Street, the secondary markets that are buying back these mortgage-backed securities, said, So those loan level price adjustments that I mentioned, those positive and negative numbers, for the two occupancies that were in the announcement, non-owner occupied and second home, jacked it through the roof. So overnight, we went from 3.75 rates, 3.5% rates to 4, 4.5, 4.75 for the non-owner occupied. So if any of you were kind of in that space back in March and hadn't locked in interest rates, you probably remember something like that. So that's kind of what we're dealing with. Ben and I were talking earlier, and I don't know if this is a good segue, Ben, to kind of get into the rate thing, but or maybe I'll hold off on that and let you ask the question. So let's fast forward a couple of months. We're now in August. Oh my God, we're in August. That just sounds weird. I don't know. I won't. That just sounds weird. So one of the good pieces of news that we received, this has been a couple of weeks ago now, there was something last year, Mark Calabria, he's getting some plugs today, at FHFA, they put an adverse marketing fee on refinances last year. And we got news just recently that they are removing that. So refinance rates have really improved over the last month and a half, I think it's been. So, you know, rates are volatile anyway, right? There's going to be the ebbs and the flows, ups and downs, et cetera. I would say that they've come back down a little bit. We're still in a great place historically, guys. I mean, people have pretty short memories as far as I can tell. And the fact that we can get 30-year fixed mortgages just to begin with in this country is pretty phenomenal. But on an investment property in the fours, yeah, I would say amazing. And then finally, and then you can go into your question, my crystal ball tells me that we are going to be in a low rate environment for the next several years. For a variety of reasons, I think. Obviously, the herd immunity, the supply chains opening up, I think are going to help us a little bit. You know, normally, you know, typically speaking, the better the economy does, the worse the interest rates do. However, I think that the biggest precipice here is that the amount of debt that we have amassed as a country over the last 18 months or whatever it's been now will make it impossible for them to move the needle in any substantial or significant way that's going to show us an increase in rates beyond, you know, an eighth, a quarter, 3/8. And that's the perspective I think that you were going to ask about, Ben, and I'll get into that.
Right. Okay. Let's see, lots of questions here, real good ones, and I've got a few of my own as well. One thing that came up is, and I'm just going to switch gears here just temporarily, and then we'll get back to the nitty gritty, but a lot of our members are very interested in, investors in general, short-term rentals, SCRs, vacation rentals. And I mean, I have one of them, and I know that from an insurance standpoint, you better tell Allstate that it's a short-term policy. You better get a short-term policy because they'll find a way not to cover it if you don't tell them. It costs a little bit more, but it wasn't that much more. From a lender standpoint, when one is buying a property, and it's not just going to be your garden variety annual rental, they intend to short-term rental it out, run a small hotel, so to speak. Do they need to tell you, or the lender, that is there special loans for that or not? Or is it just a normal NOO, non-owner occ loan?
It's a normal non-owner occupied loan, right? The how you're going to treat it at the acquisition, whether it's a short-term or a long-term, isn't significant to us. As long as it appraises and it's habitable, I don't care. Now, what does matter though is for qualification purposes. The short-term rental income, more often than not, is substantially higher than the long-term is, right? We see that a lot. And using those short-term, the rule right now, Fannie Freddie has not allowed for use of short-term rental income, okay? They will, in the acquisition year, use the long-term rental income, as I described earlier, if there's no lease, because you're not going to have a lease, so it would have to come from the appraisal. So the appraisal, 75% of that number is what we can use to offset the payment that will be created by this purchase. If it's some, you know, luxury vacation rental, let's say $1 million property, chances are the long-term income that we're going to glean from the appraisal will probably not be enough to offset that mortgage. In fact, there's probably going to be a substantial negative on there. So it's really going to boil down to your debt to income ratio where you start. Can your DTI absorb the extra there, or can it not? Some of the alternatives might be maybe you need a bridge loan just to get you going, and then you can get the income on the tax return, at which point we can use it. So let me say that a different way. Acquisition year, you can't use short-term rental income. You can only use the long-term income that will be taken from the appraisal. Once you claim the income on your Schedule E, then yes, we can give you that income the same as anything else.
Okay. So if one were to say acquire a short-term investment property, purchase price, I don't know, 750,000. And if that property had been a short-term rental for the last couple of years, so you have a nice historical, you know what it's grossed, doesn't matter, we still got to look at what that property would rent in the acquisition year as if it were an annual rental.
Conventionally correct. A non-QM product might allow you to use a rent roll from before.
Okay.
But if you want the better rates and terms, you're going to have to wait until you claim that income on your tax return.
Right. And if you're buying it in, I don't know, in year one, you need the loan now. You can't wait till you file your tax return to get the loan. So that means you're going to have to get a loan now based on the annual income, and then choose to refi later if it's worth the additional cost of refi.
And remember, you guys oftentimes, right? So think about debt to income ratio. So let's say that this property is going to make $3,000 a month short term, whatever it is, but on the long term it's $1,000. Okay, we're going to give you $750 to offset the mortgage payment, and let's say that leaves you with a loss on paper of $600 a month. If your debt to income ratio can support that and keep you at 50% or less, it's irrelevant. So don't give up the dream on the short-term rental. You got to run the numbers, right? That's the only way you're going to know for sure.
Okay. All right. Another thing that I recommend to people a lot of times, I'll get folks who call in and they're like, should I refinance, do a cash out refi on this investment property over here or something else over here or my primary? And I mean, I'm a big fan of HELOCs, home equity line of credits. Keep your existing loan that you have on that rental property. But since it's appreciated over the last couple of years, you've got $100,000 of equity that you didn't used to have. So why not find a bank, or I don't know if you do this, but that will give a home equity line of credit second position on an investment property. And there are a lot of banks that most don't, but there are a few that do. And then you've got this nice revolving line that you can tap into when you need it for whatever purpose, and then just pay it back, and so that diatribe is leading to a question. If one has a HELOC, say one has 3 HELOCs in second positions on investment properties, do those HELOCs count as golden ticket loans?
Great question. Absolutely not. You can have 10 liens on one property, and that's one finance property, not 10.
Okay.
It doesn't matter. The lien position is irrelevant. It's just an encumbered property. That's what's going to count. I agree with you. I love the idea of a line of credit. And you're right. The second lien is going to be very hard to come by. They're not as easily found. We don't do those. We do have a first lien HELOC option that maybe we should talk about doing its own presentation. It's called the AllInOne. It's probably one of the most substantial loans I've ever seen, especially for investors. It's not for everybody, but for the right individual with income and certain spending habits, etc. I don't know that there's an equal to it out there. First lien HELOC, but I love the HELOC idea just in and of itself, because you're right. You can use other people's money to keep paying this back. Your passive income from the rentals go to repay the debt that you've got. You're not paying interest that you're not using. I love it. I love it. I love it.
And I just like the idea of, I can, with the click of a mouse, get $50,000 in 2 hours, but I'm not committing to some 30-year grandiose payment. It's $50,000, whatever my rate is, I'm paying now. But if in 2 months I pay 20 of it back, my payment drops down to only a $30,000 payment. It's just really nice.
Right. I agree.
Okay. So the all-in-one, and I'm glad you mentioned that, because I remember you and I talked about the all-in-one. So it is kind of like that, but it has to be in first position. So if somebody owns a property free and clear somewhere, whether it's their primary or an investment property in Omaha, the all-in-one would work for that.
Yes, absolutely. It can be on rental properties and your primary, whatever. It's a very unique product, and takes. Definitely, if you think it's worthwhile, Ben, it really would be its own webinar. It's a very cool thing.
Yeah, yes, I would love to do that, because I read the materials about a year or two ago, and you gave them to me, but it was intriguing. Yeah. Okay, I'm just going to go through some of these random questions. Let's see. Okay, so what are current commercial rates? I mean, that's a loaded question.
Yeah. variety of variables. Again, you're gonna. I mean, I've seen rates locked in the 3s and the high 4s. So I would your range. If I'm going to give you a range without knowing those variables, 3.75 to 4.75.
Got it. Okay. And generally, how long are they? I think you said 5, 7, or 10-year arms with or a balloon.
So the cool thing now for residential, especially, we have 30-year amortizations. So that's really going to help your cash flow. But the term itself, yeah, you're going to choose between, say, if it's a balloon feature, where at the end of the term the note is due, so you're refinancing or cutting a check. So if you're refinancing, you could choose a 5 or a 10-year balloon, or yeah, you could look at an adjustable where it's not due at the end, but the rate can change, 5, 7, or 10-year arm.
So it's really nice. Even if it's a 5, 7, or 10, the amortization period is over 30.
Right.
Right.
Just
That's
like a traditional residential, yeah.
Yeah. Okay. So one little all-in-one tease. Gordon asks, what is the current rate on the all-in-one?
So like any HELOC, it's an adjustable rate, and with an adjustable rate mortgage, there's 2 components, and you've got a margin and an index. The margin of the 2 is fixed. So for 30 years, that will never change. It is the index that is variable. You add those 2 things together, and that's how you get a fully indexed rate. So depending on the occupancy is going to dictate. So non-owner occupied, there's a floor rate of 4.75. Okay, the floor rate in this case is higher than the fully indexed rate on a rental. Let's talk about the owner occupied. The owner occupied margin is 3.75. The index used is the 1-month LIBOR, London Interbank Offered Rate. It's very common use of index for mortgages. That may be changing because of Brexit, but we'll talk about that another time. And that right now I think is posting at 0.1. So 3.75 plus 0.1 would be 3.85, would be a fully indexed rate on an owner occupied for this month. It can change monthly based on where the LIBOR moves, right? I would encourage you, if you're really interested in this, do a Google search, dear Google, 1-month LIBOR. You can get 25-year historical averages. You can see how often and by how much the index has moved. You'll find it's a relatively slow moving index. It's the sister or the cousin, they call it, of the Fed fund rate. So check that out. There's a life cap too, I should mention. So if you're doing this on your owner occupied and you start at a fully indexed rate of 3.8, like I said, the life cap is 6% over that. So that means that for 30 years, your rate could never ever exceed 9.85%.
Got it. Okay. All right. Johnny asks, are the slides going to be available? And that's a perfect segue for me to say that yes, this will be archived just like all of our webinars. Just log into realwealth.com and under webinars, recent webinars, it will be front and center. Usually takes about 24 hours, sometimes 48 hours for it to be uploaded. And then it'll live on under lenders. There's Caeli and Ridge Lending Group, and it'll probably hang out there for a while, but it's not going to go away. It'll be there for a while. So you can definitely watch the whole thing.
Ben, do you want me to send you that PDF for the reserves? Would you put that in place too? Okay.
Yeah, send it to me and Celia, both.
Got it.
All righty. Let's see. Okay, a bunch more questions here. We're just going to take them in no particular order. Our own Joe asked, does Ridge service the loan after close, or is the loan sold typically to somebody else?
Hi, Joe. Good to hear from you. We are a direct lender. We fund on our warehouse line. We do not service these loans. We resell them on the secondary market.
Okay. Yeah, you know, it's one of those things. It's like you almost kind of feel jilted at the altar, but it really means not, it doesn't really mean anything. You're like, oh, you've gone through this whole process, and then you've got this new loan, and then a couple of months later, it's like your loan is being sold to some random servicer, and you're kind of like, geez, do they not like me? But it's just part of the process.
Nothing about your rate or terms or anything changes, just
right.
You make that too. Yeah.
Exactly. All righty, let's see. Will we get a sheet with all the details you just gave us? Is that the PDF you were referring to? You were referring to a cheat sheet to help determine, you know, the 1 through 6 and 7 through 10 and stuff, right?
The reserve, right? The reserve matrix, when we were talking about assets, that was the cheat sheet.
Right. Okay. So yeah, you're going to email it to us, and then we will have it, and we'll either put it on our website somewhere. Maybe we'll have it on the Caeli section on our website, or you can just email your investment counselor. I'm being vague because I don't exactly know how we're going to handle it, but we'll have it.
And we
All
do
right.
too. It's readily available. You can email us or yeah.
Okay. All righty.
And can I plug
Um,
that, Ben? I don't see it on this last slide. Do you mind if I give our email?
yeah, no, yeah.
Okay. Yeah, this isn't, there was a different slide I had on here. Sorry, everybody. So if you want to email us, obviously there's our website. You can get us that way too. info@ridgelendinggroup.com. And if you'd like to call us, please do so at 855-747-4343. 855-74-RIDGE is an easy way to remember that.
855-74-RIDGE. And you can also find you on our website. Just log in, or on the left it says lenders, hover over lenders, drop down appears, there's Ridge, click on Ridge, and there you are.
Is my high school graduation picture still in there? Did I change?
I think we updated it actually. I don't know. Don't bet on it, but I'm pretty sure we did. Okay, let's see. Does Ridge Lending do cash out refi loans on investment properties? If yes, are rates and terms the same as purchase loans?
Very good question. Yes, absolutely. We do cash out refinances. And rates, so remember, they're pretty subjective, but I'll give you an example. The LTV maximum on a single family residence cash out is 75%. If I take that and compare it to an 80% purchase, the LTV difference kind of levels out the playing field. Purchase is going to be a lower rate than refi generally, but a 75% LTV over an 80% LTV kind of messes or levels that out. So depending on the variables, you're looking at between 4 and 4.5 right now, I think. Maybe lower, maybe in the high threes for a cash out refi, depending on those variables.
I always wondered about that. It's like if I see this great house, and if I buy that house for $100,000 cash and I hold it for 30 to 45 days and then finance it, I can only pull 75% of the value out. But if I just finance it up front, I get 80%. And that never really made sense to me. Do you know what the logic is?
Well, so what I can tell you about that is that on a refinance, we can take the appraised value at
Right.
75. So if the appraised value comes in higher than what you paid for it, that might make more sense to access more leverage. On a purchase transaction, we're only going to give you 80% of the lesser purchase price or appraised value.
Okay. Okay.
So depending on the deal, it may make sense to look at the purchase. If you're really into leveraging as high as possible, it's going to be case by case. But just a quick correction, actually 85% is allowed on a single family residence with Fannie Freddie. You're just going to pay PMI and a slightly higher interest rate.
Right. That's true. You can put 15% down, but then you've got PMI, private mortgage insurance. I mean, every time I've looked at that, it's not really worth it. But maybe you've seen a million examples where it is.
Case by case, it really is the deal.
Right. Okay. All right. Let's see. I admit I don't know what SRT is, so maybe you do. What if you can only do SRT in primary home due to city regulations?
SRT, I don't know what SRT means. I can Google it.
Well, it's okay. Susie, if you're still listening, tell us what you mean by that. What's the approximate rate for a bridge loan?
Between 7 and 9, maybe more sometimes.
Oh, short-term rents. She just responded. What if you could only do short-term rental in primary home? What if you can only do short-term rentals in primary home due to city? Well, I mean, that's kind of an odd question, but I think I know what you're asking. In other words, due to city regulations, sometimes you cannot do short-term rentals. Like cities will say 30-day minimum or 180-day minimum. So
right.
then you're basically playing with fire. You can try to short-term rental it, but if a neighbor who hates you because they don't like the car you drive turns you in, you're in trouble. Probably not worth the risk. Anyway, we're getting on a tangent here. All right, let's see. If you put your rentals in a living trust, can you still obtain a total of 20 rentals if you're married with conventional lending?
Yes, as long as the loans are separate. It's the loan, not the way the title is held between a husband and wife.
Okay, it's the loan. Okay, gotcha. What are the advantages to a portfolio loan versus 6 individual 30-year fixed?
I think scalability, probably, if
Right.
anything. Some people think that it's cheaper to get one loan versus six. That's not true. You're still going to be paying for six appraisals. The cost or the lender's cost is a percentage of the loan amount. So whether it's 2 points on 100,000 or 2 points on 600,000, it's going to be the same. Underwriting guidelines are going to be slightly different. So if for all things being equal, I would say that the portfolio or cross collateralization loan, one loan, scalability maybe is probably what the real benefit there is.
Right. Okay. VA loans, are 100% VA loans higher rates typically?
VA loan is the best loan literally on the planet. You will never find a better loan anywhere. It's the lowest possible interest rate. There's no MI, 100% leverage. It's the best loan in the world.
Yeah.
It doesn't apply to non-owner occupied. Now, VA has VA loans for VA-owned properties as rentals, but you have to go straight to VA for that.
Got it. Okay. Do you lend on properties held in a self-directed IRA or non-recourse?
Good question. No, we don't do those. We've got some good referrals if anybody needs them, but you could look at, no, we don't do those.
Okay.
We have non-recourse, but not inside that vehicle.
Not inside a SDIRA, right? Okay. All righty. Good question. Do you lend to foreign nationals outside the U.S.?
Yes, we've brought back, I've played with this over the years, back and forth, but we do now have a product for foreign nationals. It's fairly new.
Right.
It's a new investor that we're working with, so I wouldn't be able to quote anything specific, but feel free to check in with us. We have the
Well, that's good to know. I mean, Canadians come to mind. I talked to one yesterday, and I just referred him to a Canadian bank I happen to know of and one other non-QM lender. So it'd be great to start sending them your way. All right. Does your company do principal home or second home loans, owner occupied?
Yes.
Of course. Yeah.
Yes. We're very, very competitive.
Okay. Do you lend for investment properties overseas?
No.
No.
We do not. The problem with that is title insurance. I have not found a title or escrow company that can provide us with the level of protection and security outside the U.S.
Got it.
I looked at it years ago, Belize actually, but no, it didn't work out.
Right. Okay. What is the current interest rate, including points, for asset depletion and DSCR loans if FICO score is fantastic, over 800?
Debt service ratio is going to have a higher rate. The lower the amount of documentation you provide, the higher the rate.
Right.
So regardless of that, we charge 2% origination or $1,500, whichever is greater, on all investment property transactions. So that would be the points. The rate is going to be debt service ratio. I would plan on 5.2.
Okay.
Asset depletion. You probably could go conventional, and in which case you're probably in, depending on your down payment, the high threes, low fours.
Right.
But can we talk about rate one more time, Ben? You and I talked about this just a little bit before we got onto the webinar here. There's a light bulb that goes off when I bring this up, because it's just not. It's one of those things that's obvious, but it's just not in your face. I know rate is important. I fully acknowledge that. I'm not downplaying that we want to get the lowest possible rate we can. But let me put it into perspective. There's that psychological thing that's going on again. Take a $120,000 mortgage, okay? And I want you to, I should probably have a number memorized by now. The difference in principal and interest between 3.875 and 4.125 is probably $10 a month, $12 a month. So while again, I do agree we want to get the lowest possible rate, make sure you're doing the math, because there's some psychology to hearing 3.8 versus 4.2 and thinking, when you're comparing, if you're comparing apples to apples, just keep that in the back of your mind.
Right. A lot of times people put too much weight in it, and it's $17 more a month, and it's not really worth worrying about.
It's not going to make or break the deal for sure. Rich does not sell rate. I will be the first one to stand up and say that. We're very competitive, I believe, but we sell service and education and knowledge, accessibility. We don't get into the, they're going to do it for an eighth better. If rate is absolutely the bottom line for you on that deal, then absolutely you will always find it an eighth better someplace.
Right.
Always.
Okay. Speaking of rates, here's a good question. What is the best rate you've seen in your career on a 30-year fixed owner-occ?
Owner-occ, 2.125.
Wow.
That I locked. I've heard of the 1.9s before. I didn't see those, but yeah.
2 1/8. That's.
I got my parents. We refinanced their loans last year when things were. Wow, last year was a ride, man. Yeah.
Wow, good for you. All right, good for your parents. All right, if the current rental properties, say you had a current rental properties and it's going through a forbearance, so in other words, whoever's there isn't paying, could the owner still qualify for a non-QM, or are they persona non grata because the property is not performing temporarily?
Such a good question, and we have some good definition about what we can do, what we can't do for forbearance properties, loans, etc. And non-QM actually and Fannie Freddie are aligned here. It cannot be an active forbearance, cannot to get qualified for an institutional loan. Your options are this: you can bring it current immediately, and you're eligible immediately, right? All you have to do is, let's say the past due is 10 grand. If you got the 10 grand, bring it current, we're good to go. If you can't do that, you have to settle out the forbearance, make 3 consecutive payments that we can see back to back, and then you're good to go.
Right. Okay. All righty. Well, that just about does it. Some of these are so detailed, I don't want to take 10 minutes because it's so specific to that person's situation. So
email them over, guys. We'll get you answered.
Right. Exactly. You can always email Caeli and she'll. Well, here's one that's fairly general. What if you have rental income from part of your primary home?
If it's an ADU or a duplex, if it's just a single family residence, right, and you're just renting out a bedroom, even if you're claiming it, I can't give it to you. If you have an ADU, accessory dwelling unit is what it is, or it's a 2 to 4 unit property, absolutely, and you claimed it, I can give it to you.
Okay, got it. All righty. Well, I think that just about does it, and I'm glad that we left this slide up. Could you want to give your full email address again?
Yes. Email us. So there's our website right there, www.ridgelendinggroup.com. Email is info@ridgelendinggroup.com. Toll free, 855-74-RIDGE is how you can reach us that way.
Perfect. All righty. Well, go on to the next slide here. I think there's something after this. And we went a little over time, but I think it was well worth it considering the questions were pouring in. And I believe that is the last slide. I don't think there's anything after this. I should know this, and there is not. So thank you, everybody, for coming on board and watching us. And like I said before, this will be archived in about 24 hours. You'll be able to watch it again and again and again. Some of the complicated mathematical concepts, Caeli, that you ripped through, maybe I'll be watching it again and again and again.
It was fast.
Yes, and there was a cheat sheet that you mentioned for reserve requirements. We will get that to anybody who asks. Maybe we'll be able to put it up on our site somewhere. And again, Caeli Ridge with Ridge Lending Group, thank you so much.
Thanks, Ben. Right. I keep being here. Thanks, everybody.
You're welcome. And I'm Ben Eric Smith. Thank you so much. We'll do it again next week and appreciate you joining us. Bye-bye.